Hi everyone. In this presentation, I will give a review of all material we take it until now. Uh, I will not talk in details, but just uh, I will give you a complete picture to enhance your understanding of the material. You have to read the books and, of course, our power presentation, every details. That's were included in exam, but in this just presentation, I just try to give complete picture or just focus on some important points. You know, this class talk about the money and banking and the financial system, and the most important is of financial. We talk about the financial system because it's include the money and banking. And the financial system is very important for economy because it's like uh, who connect the savers with borrowers or people who invest in the economy. And if you take macro class, saving and investment, the financial system, that's what we're talking about, provide canal between the saving on investment or lenders and borrowers. Therefore, this is very important for economy to ensure the flow of resources or finance of the economy. To understand the financial system very well, first we divide the groups in economy to two groups. First, lenders or savers, and second group borrowers and or spenders. Uh, and the financial system is the canal between the two that's finance uh, provide financing for economy. And to understand this, we can see that we have indirect finance and direct finance. We start from beginning. Imagine that lenders or savers first save some fraction of their incomes, and they put the money in the financial institutions, like in the form of checking or saving accounts in the financial institutions like banks. And the financial institution might use this money to directly to give this money to as loans to people or firms or uh, directly as loans. See that this and these people have liability, give liability to the financial institution, and this consider indirect finance because why? Because the transfer funds between savers and borrowers equal through financial institution. Also, we call this why we call financial intermediaries. And also, the financial institution might not give loans directly to the borrowers and spenders to invest the money or to spend this money, no matter. The financial institution might, or in fact, they do that. they enter the financial market and use the money for people to buy bonds, to invest this money in bonds and stocks. Everything is equal through financial institution is you consider indirect finance. Also, the lenders and savers might not put money in the financial institution like banks, but might be they enter directly to the financial market and buy bonds, try to invest this money directly by themselves and buy bonds and stocks for them. Uh, and uh, and the bonds and stocks exist because borrowers and spenders and especially the government and large company they issue bonds and stocks and they sell them in the market financial market to to borrow like is like borrowing. This mechanism is like to borrow money from people from others. Therefore, you know that's very important. Financial system is like the nervous system of the economy. If there's some problem here, this will cause very significant problem in economy. That might be cause recession or uh, very huge problems. We we hear it about news that if there are problem financial market, this will affect economy because there will stop the transfer of funds from savers and investors and spenders. This consider direct finance because it's like borrowers and spenders borrow directly from lenders and savers. They are now intermediary institution between them, like financial market, financial institution. This the mechanism of the financial system, and it is very important also because the prices of financial instruments, which are bonds and stocks, depends on financial market, and this will affect interest rate and therefore will affect economy. Therefore, uh, this very consider is very important, and the financial market uh, will make efficiency of distribution of resources between uh, the borrowers or spenders and lenders or savers. This is the role, some picture on the financial system on how it is work. We now see the parts, we look to the parts of financial system, what the financial system part is. The financial system consists of six parts, which is the money, because without money, how to exchange bonds and to buy and sell bonds and stocks, and give loans in the form of money. Also, there are financial instruments like bond stocks and future contracts, but we just now talk about the bonds and stocks. The financial market, this how or the place where the financial instruments were sold and bought and sold, like bonds and stocks. Financial institution, this as we talked before, like provide access to financial market and collect information and provide service for customers and maybe like intermediary between between savers and investors. The five part of financial system regulatory agencies. That's because they require by government to monitor and observe the operation in financial system to make sure is everything is good for economy and there are no some something wrong in financial system. This because if we don't monitor the financial system, maybe any problem will affect all economy. Also, central banks is very important, and sixth part of financial system is the central banks, and it's very important because central banks. We talk about this later, but just now we just take some ideas. Central banks uh, con- control the money supply through open market operation. That's mean open market operation mean buying and selling, especially bonds in the financial market, and therefore they control the money supply by this by this process, and they will try to control the interest rate in the whole economy because the role of central banks is to make the financial system is stable because we talk about the stability because movement of prices make risk to economy. The more the more stable economy, the more welfare. We talk about this later. First, we talk the first part of the financial system, which is the money. Uh, you know the definition of money. Money is an assist, any assist. I actually can say it is any assist that generally accepted as payment for goods and service or repayment of debt. Anything that in the society, if they accept it as a means of payment, is considered money. But the actually society don't accept anything as means of payment because we must have some uh, good characteristics in this assist to accept it as money. And this characteristics of money just must the money have in order to consider as money. First, it is a means of payment. That means is accepted as payment. The first, this is the first characteristic. The second is valued as a unit of account. We can we can make value, measure the value of goods and service exactly in terms of money. There are money must be we can divide money to small units. That means we're able to measure all accurately, we able to measure every good and service in terms of money. The third characteristic of money is field of as it is work or it is work as store of value. That's you. If you don't have to spend money now, you can keep the money and you don't lose the value of money and maybe you can use it later in the future. Why the money is important? We care about the money in the economy because the money supply or the quantity of money in economy is very important because the change of quantity of money we talk about this later. Just now we take simple idea about this. The change of the money supply will affect interest rates and this will affect investment and economy at this first point, and also changes in the quantity of money or money supply if increased with more than the quantity the economy that require, this will cause inflation in economy and the actually inflation will hurt the economy. Because of this two reason, money, importance of money, if the money affect this two, the money will consequently will affect economic growth. That's why you care on money and want to measure the money. It is important to measure the money to understand the money supply or to provide the economy with the appropriate quantity of money, and therefore we must measure the money. We can measure the money, how the quantity of money that in economy. Actually, to measuring the money is not exactly easy because there are different definition of money based on degree of liquidity. Uh, uh, but we can uh, we can talk about two definition of or two measurement of measuring money. That's the first the first measure is the narrow definition. This just include the currency in circulation plus demand deposit in banks because the definition of money is linked to the liquidity. It's easy. Like if when we measure the money, that's mean we try to measure the money in circulation. That's mean the money that people able to use this money in buying goods and service and everything. Therefore, the concept of liquidity is very important in measuring the money because we want to measure the quantity of money in circulation in economy. Therefore, the concept of money is related to the liquidity. Sometimes you have money, but like if you cannot use it, if you like time, but money in like time deposit, you cannot use this money. Sometimes we cannot consider it as money in circulation like that. This the narrow definition is to include the currency in circulation plus demand deposit in the demand deposits in banks. This is a narrow definition. The broader definition is include the same that what included in the narrow definition plus the time demand deposit because might be this concept don't include this time demand deposit because based on liquidity we cannot use this in circulation, but some economists say that we can use this include this as in the definition of money. There are two definitions of money, the narrow definition, the broader definition of money, uh, the broader definition of money. How to calculate the money is based as we talked before. M1 is M1 is the narrow definition is include the currency in hands in circulation in hands of the public, might be also travel checks because we consider it as currency in circulation plus demand deposits plus other check able deposit. Everything we can use it in circulation without any constraint or restriction. Consider uh, consider or enter the M M1 definition, the narrow definition of money. M2 include M1, and in addition to M1, there are uh, small diminution time deposit. That means maybe not for time deposit, might be three months, 4 months, or 6 months might be included. But for time deposit for long time, we cannot include it in this also M2. In addition, saving deposits and money market deposit accounts might be included in M2 because we can also people or can use can withdraw this money and use it as circulation. Also include retail money market mutual fund shares. We can include this one and this the M2 the measurement of M2 the broader concept or definition of money. Measure of money. We know that we have two measure of money. Which one is better measure of quantity of money in economy? Uh, I can say to you that depends and on the goal of research or what we're talking about. But in general, because we concern about uh, which part will make as a percentage of their percentage to all people use this money. uh, and changes in accounts make M2 become more useful because M2 represents nearly one half of GDP. That means more people time deposit what is included in M2 account is that's for we now concern about M2 after uh, the 80 ages. This graph show the growth rates of money aggregators like The green is M1, M2, like in 80, in after 1980, M1, the growth of M1 grew, and there are like in general, the growth of M2 is more than growth of M1. The trend, we talk about just the trend, not the movement, shortly movement. Now we talk about the relation between money growth and inflation, because if we put the data, the money growth rate on the horizontal line and the inflation rate on the vertical line, we see like from 1990 to 2013, like the relation here is is negative. Relation here is negative, like this line, the slope of this line is negative, mostly negative slope, slightly negative slope, but uh, before 1960 to 1980, 1980, the relation is positive, is positive between money growth and inflation. Inflation. Now we talk about the second part of the financial uh, system, which is the financial instruments. The financial instruments. You know the definition of financial instruments is you can read this. The written legal obligation of one party to transfer something of value, usually money, to another party at some future date under specific condition. Uh, there are many financial instruments, but I will just talk about there are many of my financial instruments like bank loans, bonds, mortgages, stocks. But in this presentation, we just focus on bonds and stocks because it's very important uh, in financial market, as we saw before. That not does not mean that banks loans and home mortgages is very not important, but is important. But we talk about the bonds prices because it's important to and the relation between bonds and how relation between the prices of bonds and interest rate and relation between uh, prices of stocks and interest rate. The third part of financial system is the financial market. Financial market where we talked about before is the place where financial instruments are bought and sold. Uh, this market are the economy central nervous system, as we saw before. And there are actually many types of financial market. I will not talk about these details. You can read the book about different types of financial market. But just we know that the most important is the role of financial market. what is the role of financial market in economy? It's very important because they provide market liquidity. They provide market by liquidity and like financing. It's very important canal between savers and investment, investors. Also, the financial market provide information for people to invest their money. They provide you now there are a lot of information they can access about the movement of prices on different types of financial instruments, bonds, and stocks, and which is more risky and the yield of investment, something like that. Also, the financial market consider risk sharing because when all people try to buy bonds and stocks, they share the responsibility uh, for economy. That's like if something happen, not this losses will not lie on just some groups. All different people in society will share these losses, and this like consider risk sharing. The fourth part of the financial system is financial institution known as financial intermediaries, like banks, insurance companies, securities firms, and pension funds. We talk because why it is said sometimes intermediaries because this provide indirect finance between savers and investment, investors in the economy. We complete the six parts of financial system. We talk about some very important concepts because before we try to analyze is what is going on in financial market and to enhance our understanding of financial system. This concept is very important to understand to evaluate bonds, prices of bonds, and stocks and interest rate, why there are interest rate or something like that. Because the first concept is time has value. Time has value. That's the time of waiting. Like if you time has value. Like if you uh, want to or someone want to borrow from you, there are costs for waiting. That's mean that time has value. That's mean uh, time not free for waiting because you can invest this money now and you get return on this money, and this time has value. The second component, risk requires compensation because you like give money to someone as loan, you might this person don't return money. There are for risk, and people take this in consideration, uh, and they will not give money until they get paid by more than uh, like just the time. They need more the compensation more than the value of time. Information is the basis. The third concept is the information is the basis for decisions, because we take the same example. If you someone want to borrow you, you must have information about this person. Why? Because you have to guarantee, or to at least their high probability they will return back. And also, if you try to invest in financial market, you must have information about which is best one, which less is risky, stocks or bonds or something like that. Uh, the four concept market determine prices and allocation of resources. Why? Because when especially in stocks, because when firms issue stocks and firms does not make good profit, the prices of stocks of these firms will go down, and therefore, like, no one want to lend this or give money to these firms, and this mechanism of prices that ensure the allocation of resources, the optimal allocation of resources in economy. Stability improve the five concepts. Stability improves welfare. This because we will talk about this later, but just concept, because when we said that when prices are not stable in the economy, they no one can predict movement of these prices. This make investment is very risky, and this the role of like central banks to stabilize the economy, because when we know the prices and uh, prices stable, or we know at least the movement of prices, that's mean we can make good investment. We talk now about the first concept. It's very important. Time has value. This time has value is like the present value. This comes from the concept of present value, and how to measure the present value. This very we now try to understand how to calculate the present value. To understand what is present value, some amount of money that you don't receive now, but in future, we just like we imagine that you have some money, some amount of money, X, say X, and you put this money in time deposit in any commercial bank, and the bank will give you fixed interest rate on this deposit. This is the value of money, because you cannot give the money to borrow, to free for money, because you can invest this money, at least by putting it as time deposit in commercial bank. In this case, a facial value, if you put this money in bank and they give you fixed interest rate on this amount of money, the future value you receive in the future that's what you receive in the future is uh, is equal to the same amount of money. That's your money, and in addition the interest rate multiplied by the amount of money. This all the money you receive after, now we say 1 year, 1 year, 1 year. Therefore, see that like is just mathematics. We can pull out or take x as common factor, and we solve this equation. Now imagine we go beyond this and imagine there are 2 years. You put the money, you put the money, uh, you put the money in commercial bank, and the commercial bank give you fixed interest rate, and you put the money for 2 years in the bank. That's mean you cannot take money until uh, before the 2 years. The first year you get this the money the same amount you get here, and the second year, because this will be all this in the end of the first year, you will have this amount of money. Therefore, in the second year, in the end of second year, they will give you interest rate on all that amount of money in the first year. Like now, just mathematics, we can multiply interest rate here in this factor, and pull out x as a common factor, and we give this equation. And if we simplify, we get this equation. That's mean it's like this first 1 year, this here 2 years. After 2 years, the future value of some money you put in the bank after 2 years, here in 1 year. See that the the change equation just here in the time. This one, you cannot see one, this two. Therefore, you can generalize this equation in for any years. Therefore, the future value of for any quantity of money that is like the present value, because you bought money now, this is the present value of x multiplied by this money. And we just interested in the present value, not in the future value. We can, like mathematics, like this become equation become like this. The present value of for any amount of money x is equal to future value divided by this term, and t is the time. But you must very important notice that this equation under condition that you don't take the money now, you take the money at the end of the year. That's very there are two important points you must notice here. The first, this in this equation you cannot you put the money like time deposit or every anywhere, but you cannot, and you take fixed interest rate, and you cannot withdraw this money until the years until the end of t 10 years, 5 years, 3 years, does not matter. In the end, before this years you cannot get anything. This important point. The second important point is t is related to how you measure interest rate. If you if we talk about, it's very important point you must understand. If we talk about yearly interest rate, the T must be measured in years. If we talk about monthly interest rate, the T must be in months. If this half year, this T must be like in half. That means the time unit here is the same as the unit. Interest unit, month or half half year, the same unit of measurement. It's very important to take in consideration. As we said, I repeat again, in this equation, you have two important points. First, this equation says that you don't receive anything before the end of the time. That's one point. You receive your money and interest rate by the end of time. This is the first point. The second point, the time and interest rate, you must be the same unit of measurement. If we talk about interest rate, we talk about interest rate in the yearly interest rate. The time must be in years. This is the first equation. But what about of if we what about if you don't receive money in the end of year of the years, in the end of time? You might receive like you make investment in some project and you receive payment each period of time. In this case, the equation in this case, this one, this if you receive money on parties each year, each period of time you receive this money, and the second year you receive this money, and the final year you receive this money, and this equation will convert it to this equation, and the same apply.